Hello and welcome to the paid weekly recap for the week ending September 5th, 2025. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel, and the creator of the artificial intelligence behind the predictive AI for dynamic market system. Before we get started, normal disclosures. Options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented in the trade ideas. If you need a few more moments with the disclosures, please pause the video here. Otherwise, we'll get into the recap for this week. So the big element of this week was non-farm payrolls on Friday. Non-farm payrolls on Friday showed greater unemployment and weaker general behavior for the economy. And as a result, we saw the 10-year yield fall significantly. Breaching the 4.1 level has been a level that we have not been able to breach since we were achieving those April lows for the broad market. So with the market at highs, we now have the 10-year yield back to those kind of levels. This raises a yellow flag for me, maybe not a red flag, because the market on the whole still continues to show strength. In fact, on Friday, the market initially tried to break out, ultimately failing on the breakout again and showing this consistent behavior, or continuing this consistent behavior of breaking out and then dipping, breaking out to a new all-time high and then dipping, breaking out to a new all-time high and then dipping. These dips continue to be shallower and shallower, so the person or persons or investors selling on those dips are not being rewarded. Those that are being rewarded are those that have been continuing to hold on, but they've not been rewarded in a meaningful way given the slow upswing of this market. The bigger rewards have come from buying into the dips and selling on these breakouts. And thus, that seems to be the natural process for this market is to sell breakouts in order to have a little bit of capital free to buy a dip. As long as that continues to work, that will continue to be the mantra. Now, at some point, we will either see one of these dips fail and a bigger pullback, thus not rewarding the buyer of the dip, or we will not see a dip. To be determined. We've got inflation data this upcoming week. That could be crucial because if inflation data starts coming in high on top of the weak looking economy from the non-farm payrolls, that could create some real concern for this market. And if inflation starts coming in low, that may shift the mode to saying that the Fed has freedom to lower interest rates further without fear of inflation. We shall see. The NASDAQ continues to lag. While the broad market, the S&P 500, made a new all-time high on Friday before failing, the NASDAQ did not quite achieve such a result. Now, Broadcom earnings did help here, but at the end of the day, we still dipped after the initial breakout from the recent range, but not to an all-time high. Ended positive on the day, though. So that's a starting point for the tech investor and to show that there is still some tolerance and desire for risk here in this broad market. Finally, small caps. Recently been the big winner. A difficult trade in many ways because these breakouts have been violent, followed by consolidation or dips. We saw it back in the middle of August. We saw it again near the end of August. We saw an attempt at a breakout, still continued firm with a positive 0.5% on Friday. But financials were weak. Some of these things are concerning. You know, if you look at a stock like JP Morgan, it was very weak on Friday. So there are some concerns out there that this market is not ready to just go straight up to the moon. Now we'll see if that changes. Perhaps again this week that shifts the mentality, but for now there is still a desire to sell breakouts and then buy dips and a rotation into small caps and out of tech on the broad spectrum of things. Now with all of this going on, the VIX is near lows. So if this market starts breaking out of the range, the low implied volatility means that leverage is cheap. Whether it's up or down, leverage is cheap right now, and it's justifiably cheap because the market isn't going a direction in an aggressive way. It is chopping still. Even with a light bull trend, it is chopping. And so the VIX is actually overvalued even at 15%, which seems very cheap if we are going to dip, or very cheap if we are going to break out. So we'll look for those signals for this upcoming week because right now with the VIX low, leverage and defined risk are very cheap. And that sets up well for paid if we do see a breakout in an individual name or the broad market. Now for this week, we had two trades held over the weekend. Johnson & Johnson, a nice day on Tuesday to turn the trade positive for the second half of the trade. So because Monday was closed, held till Tuesday, the stock only ended up about just under 1% on the week, but the options ended up at a near 5% profit. So a little bit of leverage there, a nice ending result for those options to end up in the money, a slight positive gain. Nothing special in many ways, and unfortunately, because rig ended up dipping a little bit on Tuesday before settling close to unchanged, slightly positive, but theta starts to hit. The options there did end up taking a little bit larger loss now, so going from 6 cents to 3 cents. These were effectively lottery ticket type trades because of the low premium paid. But because of the low premium paid, we only trade in penny increments, which means every penny is 17%. And so a difference between 4 cents and 3 cents shifts the return, or the loss in this case, from 33% to 50%. We don't have another trade in such a low dollar stock coming this week, fortunately. And, there are positives and negatives to it. When a low dollar stock pays off, it can turn to paying off in multiples. But when it loses, every penny matters a lot. Now, we had one new trade this week, and that was in FE in the utilities space. Utilities did not get a major buying opportunity this week. A lot of times when we see a dip in the market, like we started to see on Friday, there is some desire to go into risk safe haven assets, and that often means utilities. Utilities this week, though, were weak. So FE outperformed the utilities, First Energy, being that it was neutral on the week. But it doesn't have as great of liquidity as a lot of other utilities names, unfortunately. And the liquidity of the options actually was probably one of the biggest drivers of our return this week. Dime white options, 15-cent white options, many a time, meant that we ended up losing 22% over those 3 days on a drop of 1 penny in the stock. Having to cross the bid-ask can be painful. Again, it can be a benefit and it can be a negative. And for this week, it was a negative. When it's a benefit is when there is demand for these options. When we get a breakout and all of a sudden everybody has to buy calls to try to cover their position, we can get a benefit from that. But because there was not much movement, we ended up taking the other side of that liquidity benefit to end up with a small loss here or a loss of 22% on the trade. We'll look for new opportunities this week. We've got 2 more coming, very highly liquid names, very interesting names, and they could be a nice shift towards some big significant gains if the market does take a bullish stance this week. So we'll be looking for entries on Tuesday morning as always. If we have a bull week, we'll be looking to exit as usual, half on Friday, and that would be the ideal. But if not, if we do end up with a pullback off of some weak CPI data, i.e. high inflation, weak for the market inflation data, that can shift. So be sure you're joining in to our live trading room. The results continue to be strong there as we look for opportunities to book profits, trade spread type trades, which tend to perform better in a choppy market like this. All right, so there's a lot of spread type trades for a chopping market, earnings-based trades for a chopping market, and then there are also some directional trades that are starting to form. We'll discuss hedging strategies. We discuss a lot of individual names outside of the paid system. So if you're looking for a specific stock outside of the paid system and you'd like to get some analysis on it, both myself and Vlad are very happy to discuss those. As a reminder, opening bell runs from 9:15 till 10:15, 10:30 Eastern time. So that first hour of the trading day. Closing bell from 3 to 4, right before the close until the closing bell of the trading day. So you get 2 hours of access to Vlad and myself every day to get your questions answered and review opportunities in the stock market and the options market. So be sure to join us, ask your questions, or just listen in for some new ideas that may pique your interest for a different type of trade. And as always, if you need to reach out to us, I'm Keith at yellowtunnel.com and Vlad is Vlad at yellowtunnel.com. Happy trading, and let's look forward to a potentially interesting week with inflation data. Thanks again, everybody.